All right, welcome back. Welcome back to Lunch at the Market. What a fantastic day. Actually, it's been a very fantastic week. Hope you're doing absolutely terrific. We're having a great time here. It is a Friday at Magnum Opus Financial. The weekend is almost here. The markets are really behaving themselves extremely very nicely today. In fact, they've behaved themselves all week, and it's really been nice. Today, we're going to talk about the big loser because that's how we roll at Magnum Opus Financial. We prefer to let the move already happen and then let the market give us a trade. It is easier to let the market dictate your trade than to try to predict what the market will do every now and then, like the trades that we had this week on Amazon and on the company that I can never remember, which is Panera Bread. We broke even basically on the trade, trying to predict which one would go down, which one didn't. That's just how it rolls sometimes. So, because the market gave us a great trade this morning on Deckers, we took it. Another reason that we took it is because we were actually on the earnings conference call. And in fact, if you missed it, then you can go back to our Twitter page and read the comments from basically 4:30 to about 5:30 yesterday, because we live covered the conference call for you to help you do your homework, because we know that you're not doing as much homework as you should. So we make it easy for you to do your homework by covering those conference calls for you, or as many of them as we can get to. You should also spend some of your weekend listening to the conference calls, because I bet you missed all kinds of stuff, like Akamai. That's one that we've got to go back and listen to. We're pretty familiar with the story, but the better details, we need to make sure that we get those. And so we're going to be going back and listening to those calls like Akamai that we missed. So this week, it's a tale of two companies. We've got Caterpillar, Freeport-McMoRan, and Amazon blowing away the numbers. And then we've got Panera, Deckers, and Akamai just getting blown away because of their numbers. Really, none of the quarters were that bad. The only quarter that was really terrible was Research in Motion, which, if you've followed anything that we've said for the past 2 years, then you know good and well that we do not like Walmart or Research in Motion or Target or airlines. That's pretty much all the stocks that we hate on endlessly. We don't like airlines because you can't make any money. I mean, who thinks oil's going to be lower in 10 years than it is now? And that's their biggest input cost is oil. So unless the airfare players, unless fares for airplanes are going to go down, then cost is always going to continue to be an issue. Also, who doesn't think people are going to make more money in 10 years? Look, if wages don't increase over the next 10 years, then we have a problem in our country. Anyway, all that aside, today's big loser was Research in Motion. We actually bought some puts. Colin Gillis has been calling for a $36 price target on Research in Motion for some time now. Should have had puts going into earnings, just outright puts or long put spreads. So we did put on some September 50, 45 put spreads in Research in Motion, hoping for that full $5. I think we spent about $2.30 on that trade, and so obviously the rate of return that we could get if the spread goes to $5 is better than 100%, and we'll take that trade all day long. Deckers, the big loser, right? We waited for Lululemon forever. Finally, on April the 12th, Lulu broke $90 to the downside. That gave us our trade. We've been waiting for the same kind of catalyst for Deckers. The conference call was terrific. Okay, there were the big issue on why the stock traded down is because they're guiding to a 25-cent EPS loss for the next quarter. Why is there going to be a loss? Well, because they restructured the entire business over the United Kingdom, took a huge charge, and had to build up inventory. Why is there a giant inventory build? Well, because they're going to be a wholesaler rather than a retailer, which means that they can't get a totally terrifically great read through to all the retailers, and so they have to keep enough stock to make sure that when the orders come in that they can meet the orders. And so it's a little bit more difficult game to play, and so it's better to have a little bit more than less, because you can always discount to get rid of what you couldn't sell at full price. Whereas if you're running the retail store, then you see the channel all the way through. And so there's better margins in the wholesale business, which is fantastic because they don't have to pay all the costs of the retail stores. So that's some things that were some noise going forward. Okay, so they're going to book that charge in the second quarter. So when we see them report earnings again next earnings season, you'll see the effect of those numbers. So expect a loss and don't be surprised. In fact, I think they set the bar pretty low. And if they have a good summer, they talked about there's a possibility that they'll get reorders for warm weather footwear if we get a really hot summer. And I don't know about where you live, but it's already hit 80 several times here in North Carolina, and it's not even May yet. I don't even want to think of what June and July and August are going to be like if it's already 80 degrees in April. So, that being said, there's probably a lot of reason to be optimistic. In addition to, they upgraded their management team during the quarter, and they're very excited about that. They downsized some of the people in the retail in their retail management structure. They got rid of some overlap, so there's some costs came out there. They brought in fresh talent. They are actually still hiring. If you go to their website right now, they'll tell you that they're hiring. Things are good at Deckers. They feel the company's stronger, in a better position, more sophisticated. One of our favorite lines was they drink too much of the green Kool-Aid, meaning they try to engineer the green life into some of their footwear, and it ended up making basically a worse product. It wasn't fashion forward. It didn't fit and feel the way that people came to expect the Uggs brand to fit, many of the Deckers brand to fit. And so there was some hit there, some softness, because the look of the shoe, the feel of the shoe just wasn't what it could be, what it should have been. So they've corrected that, right? The only goal at this point is to sell great footwear. And so that's exciting to hear that management understands that it's about the bottom line, and it's not always about trying to be eco this and that. Not that they're going to go try to destroy the environment, but just, they're not going to sacrifice the look of the Deckers shoe, the Deckers particular brand, in order to try to be something that they're not. They're a shoe company, and so they're going to make very comfortable, fashion-forward footwear, and they are excited about what they have coming down the pipeline. The men's line has performed great for them. So that's obviously terrific, and that's pretty much what we have from the call. To get, again, like we said, to get more details from the call, just go back and look at the Twitter stream. You can find all those details there from 4:30 to 5:30 yesterday. All right, so what's the trade, right? What you really want to know is what's the trade. We got about 62 cents for the June 75.70 put spreads. Okay, so we're talking another $10 below where the stock basically hit the low point at about 86. Another $11 from there. We got 62 cents for those. We also got between 50 and 55 cents to sell the May and the June 82.5, 80 put spreads. So only $2.50 worth of risk, and we're taking in half of a dollar, right? Our goal is to get $1 for a $5 wide spread. We like just as well getting 50 to 55 cents for a $2.50 wide spread. We take on half the risk and get about half the return, but it's an easier position to manage and it doesn't suck up too much margin. So it's a really nice trade. It's a pretty low risk trade. We obviously could have sold the 85.80s. That really would have had some juice in it, especially at the open, but we chose not to do it because we want to be light going into the summer in case we get sell in May and go away. So far, haven't seen it, but then again, it's not even May yet. So we'll see how it goes. OPEX, when we get back on Monday, we only have 20 days left until options expiration. That's fantastic, which is why we're trying to find as many opportunities to sell May options as we can, because theta, or the options price that's going to erode as the option gets closer towards expiration, is really going to kick in the last couple of weeks. Once we get into next week, you're only going to have 20 days until options expiration, which is muy bueno. All right. Remember, buying a stock or making a trade without listening to the conference call is a lot like drunk driving, and you shouldn't do that either. So just like you would with your car, give your keys to somebody else. If you're not going to do the homework, you got to give your keys to a professional. Otherwise, you're going to get yourself hurt out there. Thanks for joining us again for another fantastic week of Lunch at the Market. Have an unbelievable weekend, and we will see you on Monday.